Hello students, I hope everyone is doing well. Let's start our today's session. In our today's session, we are going to practice some MTQs, which are going to test your knowledge of various accounting standards. So the first MTQs, which is covering IAS 16 and IAS 40. So let's start our today's session from MTQ 1. The following scenario relates to question 16 to 20. Osborn Company purchased two properties on 1st July 20x7. The company name is Osborn Company, right? The company name is Osborn Company, and Osborn Company purchased two properties, right? And the date of purchase is 1st July 20x7. Property 1 cost 900,000 and was used by Osborn as a head office. Look, at the start of the question, examiner told you that Osborn Company purchased two properties. Now they are giving you the information related to property 1, which cost the purchase price of the property 1 is 900,000 and it will be used by Osborn Company as an head office. Head office means that it is an owner occupied property. And on owner occupied property, Osborn Company should apply IAA 16, property, plant and equipment. Legal cost relating to purchase were 30,000. Legal cost is directly attributable cost and it should be capitalized by the Osborn Company. During the course of the year ended 31st December 20x7. Remember, the year end for the Osborn Company is 31st December 20x7 and the properties are purchased on 1st July 20x7 between the mid-year, right? You may say during the mid-year. Look, the year end for the Osborn Company is 31st December 20x7 and the properties were purchased on 1st July 20x7. 1st July 20x7 during the mid-year. Osborn Company, Osborn Company had to repair part of the roof at a cost of $2,000. Repairing cost, repairing cost. Repairing cost is not a compulsory cost. Repairing cost is not a compulsory cost, it's an revenue expenditure. If you remember the topic of subsequent expenditure, in subsequent expenditure, we have two types of expenditure. One is known as the capital expenditure, or which meets the three different criteria: increase the useful life, decrease the operational cost, increase in earning. So this type of expenditure are known as capital expenditure, and it should be capitalized according to IAS 16, property, plant, and equipment. But there are some other expenditure as well, which is known as the revenue expenditure. And revenue expenditure cannot be capitalized, so it should be expensed out to profit or loss. And the main example of the revenue expenditure is repairing and maintenance cost. Repairing and maintenance cost, right? So repairing and maintenance cost cannot be capitalized. And Osborn Company had incurred a repairing cost, so it should be expensed out to profit or loss. Now, if a Osborn Company want to recognize the property 1, so the total cost for the property 1 will be the purchase price, which is 900,000, right? The purchase price, which is 900,000, and legal cost. Look, the legal cost, which should be capitalized, is $30,000. So 900,000 plus 30,000, the total cost for property 1 will be $930,000. $930,000. Okay. Now the property 2 cost $300,000, which is a purchase price for the property 2, and was immediately rented to corporate tenants for $1,000 per month. Property 2 cost $300,000, which is a purchase price, right? And it was immediately rented. The intention of the Osborn Company is to earn the rental income from property 2. The intention of the Osborn Company is to earn rental income from property 2. So when the property 2 was purchased, it was immediately rented out to corporate tenant to earn rental income. So the accounting standard which the Osborn Company will apply on property 2 will be IAS 40, investment property. IAS 40, investment property, right? And the rental income is $1,000 per month, and the property were purchased on 1st July 20x7 during the mid-year. So the total rental income relating to this property for the year ended 31st December 20x7, for the year ended 31st December 20x7, the total rental income for this property will be 6 multiplied by 1,000, $6,000. It will be rental income for property 2. Clear? Now, on 1st September 2008, 1st September 20x8. Now examiner is talking about the next year. The current year end is 31st December 20x7 already given you by the examiner. So I calculate this rental income for the year ended 31st December 20x7. Now the examiner is talking about 1st September 20x8. 20x8 means the next year, the next accounting year. 20x8, the next accounting year, not the current year. Current year is 20x7. Now examiner is talking about 20x8 means the next accounting year. Osborn Company, Osborn Company converted this property into a sales office for its own use. Next accounting period in year ended 31st December 20x8, 20x8, right? The Osborn Company converted this property into a sales office. Sales office means an owner-occupied property. Now it is converted to IAA 16 property, plant, and equipment. So here the examiner is testing the knowledge of change in use, the change in use, right? Change in use. Remember this topic in IAS 40, whenever there is a change in use means when you are converting from one accounting standard to another, means from IAS 40 to IAS 16 or from IAS 16 to IAS 14. Now, the Osborne company is converting from IAS 40 to IAS 16. Now, whenever there is a change in use for the property, so I teach you, you have to follow three steps. Step 1, step 2, and step 3. Step 1 will be use the previous accounting standard, mean the old accounting standard, right? Then you have to do the transfer entry, right? Then you will follow the application of new accounting standard, right? Now here the old accounting standard is IAS 40. So we will follow the rules of IAS 40 at the date of change in use, right? At the date of change in use, which is 1st September 20x8, right? So we will follow the rules of IAS 40. In IAS 40, there are two models. One is the cost model and the other one is fair value model. If there is a cost model for this property too, so we will bring this property to the carrying value. But if Osborne company choose the fair value model for property too, or for their investment property, so we have to revalue this property to the fair value at the date of change in use. Then we will do the transfer entry. So the transfer entry is very simple. Property, plant, and equipment should be debited because it is a conversion or transfer from IAS 40 to IAS 16. And investment property will be credited. At which value it will be credited, or at carrying value if there is a cost model for property too. And if it is a fair value model, so it should be debited and credited by fair value, right? Now start the rules of new accounting standard. And the new accounting standard is IAS 16. And here you will start the depreciation of property too, right? Start the depreciation because now you will follow the accounting rules of IAS 16. And if the model is revaluation model, so any gain or loss now will be taken to other comprehensive income, not to the profit or loss. Clear to everyone? So these are the complete step for the change in use. Okay, now the fair value of the buildings were as follow. 31st December 20x7. Now the year end, the fair value of the property one is 925,000, and for property two it is 320,000. At the date of change in use, the fair value of the property two is $337,000, and on 31st December 20x8, the fair value of the property one is 850, and for property two it is 340. Extract from the Osborne Company accounting policies note are provided below. Osborne Company measured owner-occupied property using the revaluation model and depreciate it over 20 years useful life. Look, Osborne Company measure owner-occupied property for IAS 16 The model is revaluation model, and you have to depreciate the property over a 20-year useful life. Osborn Company measured investment property using the fair value model. The model is fair value model. So here, when we are applying the old accounting standard, first we have to revalue the property to the fair value. Then we have to do the transfer at the fair value, right? And then we will start the application of the new accounting standard, IAS 16, property, plant, and equipment. Now, if I explain this background information in much more detail without reading the requirement, right? So let me do some extra working. Let me do some extra working for property 2. Property 2, right? Property 2. Okay, now, if I do working for the year ended 31st December 20x7, as the examiner said that the model for the investment property is fair value model. Fair value model. Now, if I do the working for the year ended 31st December 20x7, as the purchase price, or you may say the cost of the property 2 is 300,000 already given. Look, it is 300,000. It is the purchase price for property 2. 300,000, and the fair value at the year end 31st December 20x7. The fair value of the property is 320,000. So there is a gain of 20,000, and this gain should be taken to profit or loss. And if you want to do the double entry, so double entry will be investment property debit 20,000 and profit or loss credit 20,000. Right? Now, if I do working for at the date of change in use, let me write at date of change in use, which is 1st September 20x8. Now we have to follow these 3 steps, right? These 3 steps. Old accounting standard. So according to old accounting standard, which is IAS 40, and the model for IAS 40 is the fair value model. So we have to revalue this property to the fair value. And the fair value for the property 2 is 337,000, right? 337,000. Now, the first step, revalue. So if you look, the fair value at the year end is 320,000, and at the date of change in use, it is 337,000. So there is an upward revaluation of 17,000, but let me use my calculator. 320,000 and which is a 17,000. So there is a gain of 17,000, and this gain should be taken to profit or loss, right? Now, step number 2, transfer entry. The transfer entry will be property, plant, and equipment debit, and it should be debited at fair value. And investment property credit, 337,000. Now, in the third step, you have to follow the rules of IAS 16. You will start the depreciation, right? And any gain or loss should be taken to other comprehensive income instead of profit or loss. Instead of profit or loss, any gain or loss should be taken to other comprehensive income. These are the completed steps for property 2 at the year end and also at the date of change in use. You have 2 minutes. If you have any question, you can ask. Okay, so no question. Now, according to the requirement asked by your examiner, let's answer the requirement in the sequence, right? The first requirement, in according to the relevant IFRS accounting standard, how will the legal cost relating to the purchase of property 1, examiner is talking about the property 1, and the legal cost and its subsequent roof repair cost should be recognized. So I already told you here that the legal cost should be capitalized because it's a compulsory cost, directly attributable cost. And repairing cost is a revenue expenditure, so it should be expense out to profit or loss immediately. Okay. The legal cost should be included as a part of the initial measurement of the building, right until this, and the roof repair cost should be recognized as an expense in the profit or loss. Option A is correct one. Option B, the legal cost should be included as a part of the initial measurement of the building, correct, and the roof repair cost should be added to the carrying amount of the building. So this is wrong. It should be expense out, not should be added to the carrying value of the building because it's not a capital expenditure, it's a revenue expenditure. And revenue expenditure should be charged as an expense immediately to profit or loss. The legal cost and roof repair cost should be recognized as an expense. No. The legal cost should be recognized as an expense. No. The legal cost should be capitalized. So the correct option is option A. Now, next requirement. What is the total amount that should be recognized in the statement of profit or loss? In the statement of profit or loss in the year ended 31st December 2007 in relation to property 2. For the year ended 31st December 2007, let me highlight it for you guys. 31st December 2007, we have to find the amount which should be recognized in profit or loss. In profit or loss, the element of the profit or loss is income and expenses. So we have to find income or either expense, but in relation to property 2, right? So if you remember, for the year ended 31st December 2007, the property 2 was an investment property, and any rental income and any upward revaluation in the relation to the property 2 should be charged to profit or loss, recognized as an income in the statement of profit or loss, right? So here, if you calculate the rental income, which is I already calculated for you guys, $6,000 because the property was purchased during the mid-year on 1st July, and the year end for the company is 31st December. So a rental income of 6,000 should be recognized as an income in statement of profit or loss. And upward revaluation already calculated, which is 20,000, 20,000, and this 20,000 should also be recognized as an income in the statement of profit or loss. So a rental income of $6,000 and a gain of $20,000. So a total income of $26,000 should be recognized in statement of profit or loss. Option D. Okay. Next requirement. Arrange the token below in the correct order. According to relevant IFRS accounting standard, what are the accounting steps that should be taken to correctly recognize the account conversion of property to? Account conversion means change in use. Account conversion means change in use into a sales office on 1st September 20XF. So what are the steps? Old accounting standard, the transfer entry, new accounting standard. So the first option, transfer the property between non-current asset, classification in the statement of financial position. Transfer, the transfer entry should be step number 2. Measure the property at its fair value of 337,000. Step number 1, because you have to follow the old accounting standard. And according to the old accounting standard IS 40, first you have to revalue it to $37,000. So it's step number 1, old accounting standard. Let me write this one is the step number 1, old accounting standard. This is step number 2, the transfer entry. And depreciate the property should be step number 3, the new accounting standard. IAS 60. Clear to everyone? Okay. Now let's move forward. Let's move forward to the next requirement. Which statement best describe the accounting treatment that should be applied to the decrease in the fair value of property 1? The fair value in property 1. What? The decrease in the fair value. Decrease in the fair value of the property 1. Remember, the property 1 was an owner-occupied property, and Osborn Company has to apply the rules of IAS 16. In the year ended 31st December 20X8, not X7, 20X8. Now, if you remember, the fair value at the year end was 925,000. The purchase price was 930,000. So if you find the carrying value at the year end, so it should be cost minus accumulated depreciation. As the cost is 930,000, you have to follow accumulated depreciation. 930 divided by 20, multiply 6 by 12. Which is 23250. So the carrying value will be 906,750. Now, if you compare this carrying value with a fair value, 925,000, so it's an upward revaluation. An upward revaluation in IAA 16, it should be recognized in other comprehensive income, not in profit or loss. Then, if you compare it with the year ended 31st December 20X8, there is a decrease in value. Now, what will be the treatment? Examiner is asking. Now, I'm explaining the requirement. Now, the examiner is asking that what will be the treatment for this decrease in value. Now, if in accordance with rule of IAA 16, if there is previous upward revaluation, and then there is decrease in the fair value, right? When there is a previous upward revaluation, then a decrease in value means the downward revaluation. Now, what will be the treatment for this? Now, remember, if there is previous upward revaluation, then the decrease should be offset against any previous revaluation surplus present for that asset. Revaluation surplus, or you may say any other comprehensive income present for that asset, and the remaining should be charged to profit or loss as an impairment expense, and the impairment expense, this standard is covered by IAS 36, right? Remember this note. If there is any previous upward revaluation, so first the decrease should be offset against the other comprehensive income or any revaluation surplus present for that asset, and then the decrease should be immediately charged to profit or loss. Let me give you an example. Let me give you a simple example. Let's say, for example, there is a property and the carrying value for that property is $1,000, right? Then the revaluation surplus for this property is present as, let's say, for example, $100. Now in the second year, the fair value of this property decreased to, you may say, to 800. right? 800. Ignore the depreciation expense. Ignore the depreciation expense, right? So the fair value for the second year for this property is 800. Now there is a decrease of $200. Now what will be the treatment for this $200? Now it should be immediately charged to profit or loss as an impairment expense. The answer is no. Just look if there is any upward revaluation present for this asset. If the answer is yes, first this should be offset against this revaluation surplus and any remaining should be charged to profit or loss. Then the double entry for this decrease will be asset credit by 200. First, it should be offset against the other comprehensive income $100 and any remaining figure means the balancing figure should be charged to profit or loss as an expense. Now, if there is no revaluation surplus present for this asset, remember this note as well. If there is no revaluation surplus present for this asset, then any decrease in this value should be charged immediately to profit or loss. Let me give you an example. Let's say the carrying value for the property is $500, no revaluation surplus, right? And then in the second year, the fair value for this property is $400. Now, no revaluation surplus, no other comprehensive income is present for this asset. Then this decrease of $100 should be charged immediately to profit or loss. Then the double entry will be profit or loss debit $100, and this asset should be credited by $100. Remember these two notes. Remember these two notes, right? First one, if no revaluation surplus is present, then whole amount should be charged to profit or loss immediately as an expense. But if revaluation surplus is present for any asset, so first the decrease in value should be offset against any revaluation surplus present, and then the remaining figure, or you may say the balancing figure, should be charged as an impairment expense to profit or loss. Clear to everyone? Okay. Now for this property one, already the upward revaluation is present, as I already told you. If we compare the carrying value with the fair value, so there is any upward revaluation surplus present for this asset. So the decrease is always recognized in profit or loss only. The answer is no. The decrease is always recognized in other comprehensive income only. No. If any revaluation surplus present, first it should be offset against that, and the remaining should be charged to profit or loss. The decrease is recognized in other comprehensive income to the extent that a revaluation surplus exists for property one. Yes, up to the extent revaluation surplus is present, $100, and and thereafter in profit or loss and remaining in profit or loss. Option C is the correct option. The decrease in recognized in profit or loss to the extent of previous increase in fair value. No, the decrease should be charged to other comprehensive income, not profit or loss. Okay, a student is asking that you already explained this concept in IA 16. Yes, I already explained it in IAA 16, right? But I am explaining it again and again during my practice session, so you have a strong grip on the accounting standard. Many students confuse when there is a decrease in value and already the upward revaluation is present, so they charge immediately their decrease into the profit or loss or other comprehensive income. So therefore, I explained each and every concept in my revision sessions, right? In my practice sessions. Okay, now the last. Which of the following properties, which are also held by Osborn Company, should not negative requirement be recognized as an investment property? Which of the following is not an investment property? Red House, which is an apartment block occupied by Osborn Company employees, already explained in IAS 40. All whom pay the market rent, if they pay the market rent or if they don't pay the rent, if the property is occupied by the employees, that property is an owner occupied property and you have to apply IAS 16, not IAS 40. So this one is correct option. Blue Tower, which Osborn Company rent from unrelated property and sublet it to the corporate tenants. Corporate tenants want to earn the rental income. It is an investment property. Green Palace, which is land held for undetermined future use. No future use is decided. Always an investment property. Black Center, which is a shopping center led to retailers. Osborn Company want to earn the rental income. Osborn Company provide maintenance and security services to the tenants. Now here is another concept. Osborn Company provides the maintenance and the security services to tenants. Now here the Osborn Company is providing two services. One, they provide their shopping malls or the shopping center on rent to their retailers, and also Osborn Company giving other services as well, which is maintenance and security services. So which standard should be applied? Should we apply IAS 40 because the Osborn Company is earning the rental income, but the Osborn Company is giving other services and he is charging them, means the retailer, for the other services as well. So for other services, we should apply IAS 16 property plan and equipment. Now, which standard should be applied? Now, you have to apply their accounting standard, whose income, whose economic benefit prevail the other accounting standard. Now, if the rental income prevail the other services, so Osborne Company should apply IAS 40 on this property. But if IAS 16 mean the income of other services prevail the rental income, so Osborne Company should apply IAS 16 property, plant and equipment on this property. Now we will assume that the Osborne Company is earning the rental income more than the services, means the rental income is prevailing the other services. So this property can be recognized as an investment property, right? So this was an MTQ number 1. If you have any question, you can ask.